Access to Democracy is made possible by donations from the following organizations. Thomson Reuters, a global company with expertise and insight to unravel complex situations in the areas of law, tax, compliance, government, and media. Their worldwide network of journalists and editors keep customers up to speed on relevant global events. Crutchfield Dermatology, a full-service treatment center and Medi-Spa in Eagan. Their goal is to help you look good and feel great with beautiful skin. With service built around courtesy, dignity, and respect, Mayo-trained Dr. Charles Crutchfield personally treats each patient and is acknowledged as one of the nation's best physicians. Truestone Financial, with locations in Minnesota and Wisconsin, has proudly served its members since 1939. Truestone engages, educates, and supports its members to ensure they have the tools to empower their financial well-being. Truestone Financial, your neighborhood credit union. Learn more at truestone.org. Edina Eye Physicians and Surgeons, a division of Twin Cities Eye Consultants, has proudly served the Twin Cities for more than 55 years now in 7 convenient locations. Using the most advanced technology combined with human touch, Edina Eye offers comprehensive services and dedicated specialists committed to excellence with innovative procedures and expertise for the most advanced eye care.
Welcome to Access to Democracy. I'm Mark Alevizos, the guest host today. Today it's our pleasure to have with us Thomas Lewis, who is the managing partner of Lewis & Associates PA. Welcome, Tom.
Thank you. Glad to be here.
And you are a CPA, actually I understand, with a master's in taxation?
Yes, that's correct.
From, where was that?
Washington School of Law.
Okay. And you have your own firm that you started
in 1973.
In Minnesota?
Edina.
Edina, and you
Been
still
there.
operate that presently?
Been there ever since.
Okay. And today we thought we would talk about a vexing issue that one of the certainties in life, as we've been told, death and taxes. And taxes, it seemed to us in our work in financial planning and retirement planning, tend to be a very big issue, particularly as people start to decumulate their assets.
Right.
And we've seen that actually has gotten more and more complex since the original 1913 taxes came out.
On one sheet of paper.
When it was on one sheet of paper.
Right.
And we thought we would dive into some of those topics today. What do you see new in the tax horizon for us?
Well, in the August 3rd issue of Wall Street Journal caught my eye because the headlines there said IRS is turning into a beast mode. Yeah, and so I thought, what does this mean?
Huh.
Well, reading on in the article, it said that Senators Manchin and Schumer have come up with this bill where they're going to raise $80 billion for the IRS to increase enforcement and collections, and they're expecting for the $80 billion that they're going to spend to increase the IRS, they're going to get about $200 billion back, they think. And out of this $80 billion, they're allocating $45 billion to enforcement.
Which really is a lot more than there was before.
16 times more.
My goodness.
Yeah. And so what does this mean to us? I think this means the IRS is going to be coming after a lot more taxpayers than they have in the past. They've been kind of in snooze mode lately. I mean, I haven't seen much in the way of audits in the last 4 or 5 years, but I see an onslaught coming right now.
I have heard of cases in the past where auditors, sometimes young auditors, would come and ask questions like, why did you retire of an individual that had worked for like 40 years? And they said, I'm ready to retire. And they just were very, it seemed like difficult with the taxpayer. Is that something that you've seen in your career?
Why did you retire? Yeah, I know.
Or the difficultness of sometimes the interview?
Well, the IRS agents will sometimes ask leading questions, and there's a reason for it typically. For example, I know at the beginning of most IRS audits of individuals, one of the first things they're going to ask you is, do you ever do any bartering? And a lot of times taxpayers are like, well, what does that mean? And they'll say, well, do you ever trade services with somebody? And of course, the taxpayer unknowingly might say something like, oh, yeah, well, I traded with George down the street there. I mow his lawn, and he fixes my things around my house, appliances and whatnot. Well, he just told the IRS he's got unreported income is what he just did.
Oh, my.
So they do
Which
stuff
is one
like
of
that.
the tougher things, that you don't want to not report income, right?
Not willingly, no.
Right.
But yeah, so anyway, in that article it goes on to say that one of the targets in this according to this article, that the IRS is targeting is what they call pass-through entities.
Mm-hmm.
Now, pass-through entity, what's that, you might ask? It's like a partnership or an LLC,
Yep.
where the income and dividends and interest and items flow from the entity to the individual people. And the reason they're looking at, in particular, S corporations is because a lot of people have taken advantage of a loophole there within the S corporation. And would you like to hear about the loophole?
Absolutely.
Anyway, it works like this. If you are unincorporated, the IRS, by default, you report on Schedule C on your 1040, as you may know. Or if you're in business with other people and you don't have any other kind of legal entity, then you're a partnership and you report that way. Now, if you're a Schedule C, and let's say you have $100,000 of income, okay, you're going to pay maybe 20% federal tax, 5 to 10% state tax, and on top of that, you have what they call self-employment tax. Okay, so what's a self-employment tax? Well, that's FICA Medicare.
Right.
And when you work for somebody, you pay half and your employer pays half.
Right.
But when you work for yourself,
You get
pay
the opportunity
both.
to pay it all.
Yeah. So after all done and said, you're paying 45% from 0 to 100,000 and more in taxes. And that's why a lot of small businesses fail.
Yep.
And so the IRS has this entity called an S corporation, which is also a pass-through entity. And this is what the IRS is looking at, because if you have an S corporation, what you can do with the same $100,000, you can make your W-2, which is subject to FICA Medicare, anything you want. So if you got $100,000, you might say, well, why make any of it a W-2? Well, the answer is the IRS doesn't like that. In fact, there was a case where it was actually an accountant had $200,000 of income and he had no salary. Well, they audited him, took him to court, or he took them to court, and when it was finally resolved, the IRS, the court system decided about 30% is about right. So we've been using 30%. So in our example, if you make out your W-2 to be 30%, that's what, $30,000, right?
Right.
30,000 times 15% is about $4,500,
Right.
right?
Right.
So do you want to pay $15,000 or do you want to pay $4,500 on the same income? That's the so-called S corp loophole, and that's why the IRS is going after some of these S corps that where this may have been, people might have been fudging with that W-2 a little bit too much, and it should be more than it is. But there is a clause in the code that says that salary has to be what they call reasonable, which leaves a lot to be desired.
And so are there tactics or defenses that people should be employing or looking to do?
Well,
so
you want to
they're not in that bullseye?
Well, you want to make sure you have a W-2, first of all, if you're like a single person S corp of some magnitude. Of course, if you have a loss, then nobody cares. But if you're making pretty good money, you should have a reasonable W-2. One other thing I might add, that if you are a Schedule C, unincorporated, Schedule C Form 1040, and your adjusted or your gross income in your business is over $100,000, your chances of being audited are about 5 times greater than normal. Why? Because when the IRS audits you and they're auditing your business, they're going to look at your mileage. Do you have all your logs? They're going to look at your meals and entertainment. Do you have receipts for all your entertainment? Do you have the who, whys, whens, and what fors of all the people you entertain? And then they can also look in your contributions. Did you make contributions especially non-cash? Do you have receipts? Do you have everything in order? So when they look at a S corp, or not an S corp, but a proprietorship with over 100,000, this is just a lot of plums in there for the IRS to pluck. So you want to, if you're over 100,000 in gross income on a Schedule C, you want to avoid that and maybe become an S corp.
Okay.
And not to mention you're going to save all that FICA Medicare as well.
Right. And it looks like the IRS will be going after probably more and more individuals for audits. Any word on how will we be hearing more about that in the future here, do you think?
Well, I think like we're telling our clients, what you want to do is right now is button up your tax returns so they're ironclad. So if you do get audited, you really got nothing to worry about. And the way you do that, number one, file on time, pay on time, and you shouldn't have any problem. And if you get, every January, everybody gets these important tax information in the mail, right?
Right.
You guys send them out too.
Maybe February sometimes.
Yeah. And so when you get those, make sure you keep them. Don't throw them away. It's important, just like it says.
Right.
And you're going to need that for your taxes because whatever's on there, the IRS has too. And they got these computer...
They have to match it.
Yeah, they got this computer matching thing that if they don't just match up right, you get the nasty gram.
Yep.
And you don't want that.
And I've seen instances where things are actually misreported. I've seen a financial institution misreport like a rollover of a 401k that was rolled over, but they used the previous year's data. And the IRS didn't match it. And that individual thought they had like an $80,000 rollover or increase in their income in that year until it was found out that the financial institution had a problem.
Well, the only solution there is you have to write a letter to the IRS and get your financial advisor to chip in and show them that something went wrong and that this taxpayer is right and the IRS is wrong. But speaking of the IRS sending out letters that are wrong, it was some years ago, it was reported by the what's that government audit? GAO, I think it's called. Government auditing branch that actually audits.
The GAO?
GAO, the organization that audits the government themselves.
Government Accounting Agency?
Yeah. Anyway, they went through some letters that the IRS had sent out to taxpayers saying they owed money because of this computer mismatching. Because a lot of that stuff nobody looks at. It mismatches and the letter goes out the door,
Right.
And so they found out that 60% of those letters were wrong.
Wow.
Yeah. So if you get a letter from the IRS that says you owe, that might not be true.
Well, that's hopeful.
Yeah. And I can say from my own experience, we always tell clients, don't even open it, just send it to us.
Right.
When you get a letter from the IRS.
Let you worry about it.
That's right. That's what we do. We take care of that sort of stuff.
You did mention about filing on time. That includes extensions, though, too, doesn't it?
Well, here's a mistake some people make, though. Filing an extension does not extend the time to pay the tax.
Right.
If you think that's true, you're going to get a 25% late paying penalty.
That's
on top
a big penalty.
Yeah, and plus interest.
Right.
So, and when you file an extension, you want to make sure with the extension, there's even a place, there's a line for it, that you want to pay something in that you think that you're going to owe, and if anything, guess high.
And then how about examples of things that you've seen in your career that would be of interest to the viewers today that might help them? Any tips on what they should be doing? Well,
a lot of tax preparation office send out a thing in early January. I know one year we sent them in December and we got scolded for ruining people's Christmases. So from now on we send them after January 1st. And they're called organizers and they have last year's data on there, so make sure you don't miss something. So if you can get a hold of an organizer from your tax preparer, or maybe I don't know if TurboTax has them or not, but look at that, because you might want to compare that to what you're putting on your tax return this year so that you don't miss anything.
I've seen some of those, and they're quite detailed.
Right.
It takes you a while to fill those out.
And in a lot of cases, like in our organizers, we had like 4 pages of questions. Some of them seem kind of mundane, but they're important questions because they lead you to other things. You know, like, for example, do you deal in cryptocurrency? Yes or no? Well, if you look on a tax return, right under your name and address, right on the 1040, the IRS asks that question. Did you deal in cryptocurrency this year? Yes or no? And if you say yes, they're going to be looking for something on your tax return. If you say no, and it turns out you did deal in it, you lied on your tax return. May not be a big deal depending on how big the lie is, but speaking of cryptocurrency, and a thing, I don't know if people know this or not, but the IRS views crypto transactions as property and not money.
Yes.
That's a big deal.
Yes.
For example, this is exaggerated, but let's just say you bought some cryptocurrency and you go to Burger King and you buy a burger and some other stuff for $15 and you hand them cryptocurrency. Fine, they take it. You're happy. Well, that's going to be a transaction you've got to report on your tax return next year on Schedule D. You're going to show that burger for $15, and then you have to show what you paid for that cryptocurrency. And if you paid $10, you're going to have a $5 gain.
So a gain, capital gain.
Capital gain,
Wow.
yeah.
We have a lot of learning, I think, that's going to be happening with cryptocurrencies and bitcoins and whatnot. Any other examples that might be salient examples that you could think about that might be helpful for listeners?
Well, again, keep all your 1099s and make sure they match up where they're supposed to be on your tax return. Would be the most important thing that I can think of. Another thing is the IRS seems to have been hitting harder lately is non-cash donations. You know, that's the stuff, you clean out your garage and you put in bags and whatever.
Which everybody's been doing the last 2 years. They've been cleaning out houses and garages.
Well, if you want to deduct that, you want to be careful. On the form, in 82, 83, I think it is, it asks you who you gave it to, the address, the date, how much was it when you bought it, and how much was it worth when you gave it away,
right?
Stuff like that. Now here's a good one. About an IRS person one time I ran into. So she's auditing this person's non-cash donations, and she's saying, okay, you say you paid $5,000 for that thing. Can you prove that? And I'm like, she doesn't have to prove that. And the IRS agent says, yeah. I said, we have to have an invoice from when you bought that. I'm like, who does that?
Yeah.
Do you do that? No, nobody does that. Well, yeah, you have to do that. Well, I said, okay, show me when in Internal Revenue Code where it says that you have to do that.
Right.
And of course she couldn't. But this is what they do. They'll tell you things that are not true, and they get away with it.
And are you typically involved in audits with, you sit side by side with the clients in the audit? Have you done that?
Yes. Not side by side. We prefer they're not there.
Oh, is that right?
Yeah. The IRS doesn't like that, but we prefer they're not there.
And typically, where do you take those meetings? Where's the best place to do something like that?
Well, it depends on whether it's a business audit or a personal audit. Sometimes the business audits have to be done at the taxpayer's business.
Okay.
You can't avoid that. But most personal audits, we do it right in our office, or we'll go to the IRS if that be the case. But typically what we do is when they get the letter, and everybody's scared of these things because they give this laundry list of things they want, and some stuff they have and they don't have. Well, the IRS doesn't know what you have and don't have, and so it's really a fishing trip.
All-inclusive list.
Yeah, they're fishing. Just trying to see what you got that they can look at. And so we'll go through it and figure out what they got and what we've got, and then we bring it all together, and then we make the appointment. We get a power of attorney, Form 2848, to represent the client, and then we usually tell the IRS that we are representing the client. You're not going to see them. You're going to come to our office, and we got the boxes of stuff that you want to go through or whatever there, and we got a place for you there. And we try to make it the most uncomfortable spot in the office so they don't stay too long.
Well, hopefully you don't have to go through too many of those, but I can imagine that it can be a very stressful event for people. So the more you can do on the front end, I would imagine, like any planning,
right?
Really makes the back end better.
And again, what you need to do is go through your tax files, and if you got travel, you want to make sure you have all the why, where's, what for, and you got to show. I mean, when they look at travel logs, you have to show the day you made the trip, where you went, why you went, name of the client, how many miles, every single trip. They require that, and they're, so you have to show that. And if you do some entertaining, you have to show who it was, why you entertained them, where it was, how much you spent, and what the business purpose was. All those things. You have to prove all that.
Can I ask you a little bit of when you first remember starting your firm in 1973?
Yeah.
Some of the differences from then and now in terms of how taxes are done?
Yeah. When I started in 1973, I had previously been with a CPA firm, and they had a lot of real estate investment clients. And back then, if you invested in, like, say, multi-housing investments, you got depreciation.
Right.
And it was real short. It was like 15, 18 years. So you could invest over here in real estate, and you get these big losses, and then you could take those losses and offset your other income, like W-2 income over here, pay no tax.
Right.
And I thought, I got to do that. And I got to help people do that.
Oh.
And that really got me started, because there was a lot of limited partnership real estate businesses in those days that were starting up, and that was kind of how I got my start.
Huh. And then how did you go from there? You did a lot of those? Or did that, because it seems like the laws changed late 70s, early 80s a bit.
Everything was rolling around pretty good through the 70s and into probably the mid 80s. Then in 1986, they came up with a Tax Reform Act, they called it, 1986 Tax Reform Act, because all these rich people are not paying any taxes because they got tax deductions against their other income. And you can still do it today if you're a real estate professional, which means you have to spend like 750 hours a year on real estate matters.
Right.
And even if you're husband and wife, if one of you qualifies, that qualifies both of you.
Okay.
But they came up with this law, and they phased out those losses so that if you make over 150,000 nowadays, you don't get the losses, but they get what they call suspended. You don't lose them, but they just get pushed into the future.
To a year when maybe your income isn't quite as high? Or?
Well, to a year when that property makes money, or you sell the property.
Okay.
Then you can use those losses
against
and
the gain.
Offset that capital gain.
Okay. And then what was the big transition then in '86 for you? You saw less and less of that type of real estate, those deductions in business?
Yeah, there was a lot of what happened was when they passed that law, a lot of the investors who had kind of marginal properties, like in a, I don't want to say ghetto, but in a lesser desirable areas of town, were hanging on to them and putting money into them, and probably losing money to keep them going, not because they like losing money, but because they got the tax deductions, which were probably more than the money they were losing. So a lot of those kind of marginal properties went back to the lender. And I don't know if you remember or not, but a lot of these lenders went bankrupt.
Yes.
There a lot of savings and loans that were heavy in the real estate.
Late 80s, early 90s there.
Yeah.
Until the RTC, the Resolution Trust Corporation, came in.
Right.
Very much. So it was an exciting time. As the policies get set in Washington and the tax regimes get set up, so goes investors. Investors are going to put their money and income in certain things, and that's where it makes a lot of sense, I think, to be thoughtful in the way one handles their taxes. Any other ideas for people before we sign off in the next couple of minutes here?
Well, you want to hear a short IRS story?
Sure.
Okay. There was this lady a few years ago. She got a letter from the IRS. They did what was called a correspondence audit. That means they don't want you to come in, but they want you to wrap this stuff up and send it to them. These people were like in Denver or someplace. So she did, and they came back after a few weeks and said she owes $15,000.
Okay.
And she's like, and I look at it and go, well, they're wrong. Well, they're trying to say what she was an insurance person, not an agent, but a person. And insurance people are a little bit different. They get a W-2, but in many cases they call them statutory employees, which is a little different. You probably wouldn't even notice it on your W-2, but it's there.
It's like life insurance?
Yeah.
Sales?
Well,
agents?
Yeah, life insurance. And when you're a statutory employee, you get a W-2, but then you can deduct your deductions against it, because usually the insurance company doesn't cover any of that, like your travel and entertainment. Right. So that goes on at Schedule C. So you got this weird looking Schedule C that has no income and all these deductions. So it catches the eye. needless to say, of the
Right,
IRS.
a little imbalance there.
And so at first they said, well, you have a hobby there. That's what they first said. I'm like, hobby? How can that be a hobby? Well, because because initially they thought because she had all those losses, it must be a hobby. Well, they were wrong on that, and they agreed that was wrong. And then they, I don't know, they came back some other way. Anyway, it went to appeals. Well, meanwhile, this lady says, well, I just want to pay it because I just want to get rid of these guys. I said, no, they're wrong. And we went all the way to tax court date.
No kidding.
Yeah, and she was worried about it because they set the tax court date out like 9 months or something like that, and it was all set and ready to go. And she's like, oh my God, do I have to go to tax court? Do I have to go in front of this Judge Judy or whatever and plead my case? I said, no. I said, they won't do it because you're small potatoes and they don't want to spend their resources on that.
That's right. Attorneys and everybody have to show
Yeah,
up.
and sure enough, about 30 days before the tax court date, I get a call from the IRS attorney from the IRS. And she said, well, we want to settle this right now. And I said, well, you're wrong. Look at the case. And so she did. And she came back and at first she said, well, I got to talk to my superiors about this. I said, okay, call you tomorrow. Okay. So she called me the next day. Forgot the whole thing. She said they were wrong. Field audit was wrong. Appeals was wrong. Did she know a dime?
Oh my goodness.
Yeah. So it pays to fight them.
Huh.
Or actually, it can pay to fight them.
Sure. And how'd your client feel that day?
She said, well, I didn't think I would have anyway.
Well, that's something. They have to go to tax court. That's not, I think, on most people's
yeah.
agenda of what they'd love
Well,
to do.
in that article, it said, too, that we were talking about earlier, that the IRS is probably going to pick on people that are in the high to middle income categories.
Sure.
And they're only going to hit the higher up beyond 500,000. They're only going to get 5 to 9% chance of being audited, because the higher income people hire high test attorneys and whatnot, and they fight them, which is expensive.
Right.
The lower people, bracket people they'll just pay up.
Oh man.
So they're betting on that.
Yeah, they are. It's almost like bullying sometimes. Hopefully it's not, we don't see a lot of that. But Thomas of Thomas Lewis and Associates, I wanted to thank you for coming in today and sharing your thoughts with Access to Democracy. We talked a little bit about the IRS going into beast mode, the national publication that talked about that, and also the income tax. One sheet of paper back in 1913.
By the way, Elizabeth Warren wants to go back to that.
Wow.
In fact, they're giving her I don't know, $1 billion to research that.
Well, thank you so much for coming in, and this is Mark Alevizos for Access to Democracy. Thank you.